All right. Today is Thursday, March 30. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And oh boy, here we go again. We have yet another gap higher. You know what they're doing right now. The money managers, they have to score their bonuses. It's the end of the quarter. And of course, they pump using the pre-market session so nobody can get in. And they pump the mega cap names. That's the easiest way to pump the indices. And then once they get their bonuses, they pull the rug. We're going to talk about this a little more because it's not just about the end of the quarter. It's also the sentiment that's going on right now. And it is absolutely dangerous. But let's start with this. A lot of you have been asking me because of the breaking news, what do we do with the whole indictment of former President Trump? All I got to say, it's a political circus. It has nothing to do with the stock market. Although, last time I checked the Truth Social stock, the DWAC, the Quack, that's up about 10%. So maybe if they execute Trump, the stock will double in value. But all joking aside, I mean, we traded the market back in January 6th, right? And actually, if you remember, the stock market went higher. And back during that time, I produced a video and I called it Civil War Optimism. And YouTube took my video down. I was sarcastic. I was making fun of how the market has no emotions at all. Doesn't care what's going on at all. It was an absurd market. And today we got yet another absurd market. It's not just the pumping of the end of the quarter that is responsible of the gaps, but this has been a process that's been going on since the implosion of the Silicon Valley Bank. We talked about why. What is leading the stampede of buying right now? But maybe, of all people, Jim Cramer will explain this to you precisely. Take a look.
When the book is written on the market's performance this month, there will be one lone hero. One company that launched rallies in hundreds of good stocks, and that savior was none other than the failed Silicon Valley Bank. Yet the useful idiots at the helm of the previously smart merchant bank set off a domino-like financial catastrophe, and we have to thank them for it because the crisis stayed the hand of the most aggressive Federal Reserve in 40 years. Without the overnight collapse of Silicon Valley Bank, we might have been hit with an additional 50 basis point rate hike on top of the quarter point we got last week. That's how hot this economy remains. And I bet the averages would be substantially lower than they stand right now.
And he's not really wrong. Absent of the implosion of Silicon Valley Bank, we would have gotten 50 basis points from the Fed and the stock market would have crashed. But now, because we have the fears of systemic risk, the Fed delayed the 50 basis points, went with the 25 instead, and now we have all of this speculation that the Fed will pause, if not cut rates immediately. And this is supposed to be good, and we have to stampede and buy the stock market right now. And it really illustrates the importance of the US dollar. We talked about it in yesterday's video. Watch the dollar. If the dollar starts to pop again, we got a problem. The rally will end. Look at the correlation between the Dixie and the QQQ for the Nasdaq. The Q's in white, the Dixie in orange. And the dollar usually rises higher in times like this based upon expectations that the Fed will do more tightening of the monetary policy. Yet the dollar goes down in expectations of Fed loosening of the policy, be it by pausing or, better yet, rate cuts. And you can see every time we saw the Dixie, for example, bottoming and moving higher, the rally in the Qs went south. Likewise, when the Dixie topped, we saw the Qs putting in a bottom and rallying higher again. Until, of course, we got to the SVB episode, we saw the Dixie and the Qs trading together. And that was the hint, the clue, the little peek of the upcoming recession theme, in which the indices will trade hand in hand with the dollar. The dollar goes down, they'll go down too. But in the meantime, so long as we have the fight against inflation, we have an inverse relationship. And as of late, the Qs has been rallying based on the dollar going down. But if the dollar rebounds, the Qs will go down. We have inflation data coming out tomorrow. And then we have more and more macro data coming out next week. Anything could trigger the dollar to move higher. And that would be the rug pull when it comes to the Nasdaq and the entirety of the stock market for that matter. But we go back to why are the bulls / the Jim Cramer crowd assuming that the collapse of SVB will push the Fed to cut rates? Because what about the inflation inflation problem. That hasn't been solved yet. They would counter and say, but we have systemic risk, we have tightening of credit conditions by banks, and that should do the job for the Fed. They will no longer need to increase rates so long as the banks are doing the jobs for them by tightening credit conditions. The problem is, this assumption is overblown. You cannot really assume that banks, because of the implosion of Silicon Valley Bank and a few smaller banks, will start to stop writing loans just because, we have to tighten credit conditions right now. Because what we're seeing so far by the bond and the stock market is the following. Hey, banks, go ahead and write those loans because bond yields are going down. So you no longer have to worry about yields rising higher. You can go ahead and write all these loans, and there is not going to be tightening of credit conditions at all. Listen to the demon from Minneapolis, Neil Kashkari. He also expressed concern about this assumption. Take a look.
My experience, I was in the front line of the 2008 financial crisis. Banking panics and banking stresses tend to take longer than you think until, in the 08, it took a couple of years. I'm not forecasting that. I don't think we have that kind of situation here. But every time in 08, we thought, okay, we're through it. There was another shoe yet to drop. So I'm prepared that this could take a little longer than we expect until we fully get behind it. But the banking supervisors are very focused on it. And the vast majority of banks have taken potential interest rate risk seriously and have positioned themselves for that. And so the banking system is sound. Banks on average have a lot of capital. The Federal Reserve and the other banking regulators are standing behind the banking system. And so that should give us all confidence. But it's going to probably take us a while till we fully understand, are there more losses out there? The other thing is, what's unclear right now is how much of the banking stresses of the past few weeks is leading to a sustained credit crunch, which would then slow down the U.S. economy. Those second and third steps are still unclear for us right now, but we're watching very, very.
So maybe the tightening of credit conditions by banks will not happen to begin with. And even if it happens, there is no guarantee that it will take care of the inflation problem on its own. And tomorrow will be a critical day because we have PCE inflation. And economists are now expecting core PCE inflation to rise higher. And that could be a massive wake-up call for the equities market. But it's not just that. The bulls and the Jim Cramer crowd are missing two things. Number one, inflation, but the rebuttal is, but the banks will do the job for the Fed. Well, Neil says maybe not so much. And the other point the bulls are missing is the Fed is saying we're gonna raise rates. The fight is not over yet. For example, listen to Boston Fed President Collins today.
Inflation does remain too high. Recent indicators reinforce my view that there is more work to do to bring inflation down to the 2% target that we associate with price stability. And I want to say why I see this as so important in a moment, but first let me just say a little bit about banks. Our banking system is strong and resilient, with well-capitalized institutions and ample liquidity.
So she had to plug in the propaganda message of our banks are strong and resilient, really? Our central banks, the big dog of banks, the Federal Reserve, is now sitting at a staggering amount of unrealized losses. And that's the sugar daddy. The sugar daddy is about to go bust. But it's not for now, thank you to the reserve currency of the world, the dollar, which, by the way, it's about to go bust. With China, Russia, Saudi Arabia, Brazil all signing deals now to trade commodities using the Chinese yuan. But until that day comes, the rebuttal by the bulls when we say, what about the Fed? They say they're going to raise rates higher to combat inflation. What do you got to say about that? Here's a sample for you.
What if the Fed isn't kidding, right? I mean, we've had more Fed speak just today, yet again, suggesting more rate hikes are coming. They don't believe that inflation's dropping like a stone, apparently.
They have to say that. They have to be guarded. They can't seem like they're getting behind some rally. They have to talk tough. But
so when the bulls say, the implosion of Silicon Valley Bank is good for the stock market because it pushes the Fed away, the rebuttal becomes, what about inflation? But they got an answer for that. Banks will take care of that. The Fed doesn't have to raise rates anymore. And then you say, but what about the Fed? The Fed saying that they're going to raise rates. The Fed is bluffing. Don't worry about that at all. And even if all of that's not true, even if we're going to have a recession, it's going to be a modest recession, mild recession. How about soft recession? That's That's going to be the new buzzword. And they're going to keep playing this game over and over and over until they finally capitulate to reality. But when that happens, it's going to be an absolute tragedy. Think about the billions and billions, if not trillions of dollars being pumped right now, right into the slaughter. That will tighten the monetary policy for the Fed, not banks tightening credit conditions. It's trillions and trillions of dollars being lost in the stock market. That will indeed take care of inflation. But today we got some samples from the European Union. We know that Europe has a problem when it comes to energy prices, at least they used to. Apparently not anymore, but there's something called the base impacts. So now we're getting readings for the month of March. We know that the same time last year, energy prices spiked significantly higher due to the Russian invasion of Ukraine. So when you pin today's numbers with last year's numbers, it would appear that inflation is going down dramatically. But the problem is core inflation, aka sticky inflation. This is going to be the problem from this point on. Even here, we know that the inflation reading for March in this country will go down. The headline will be down. Maybe we're going to go below 6% year-on-year inflation rate, but month over month we're going higher. And most importantly, core inflation will continue to be sticky and will continue to go higher month over month. And this is a major problem and a major challenge to the delusion that's going on in the stock market right now. And this, of course, will spike the dollar and hence the rug pull. But look at the Spanish CPI, for example, that we got in the morning today. It got cut by half. The inflation rate in Spain right now is about 3%. That is the headline reading. But the devil is always in the details. While the headline reading went down because energy prices, specifically gas prices, went down year on year, core inflation in Spain remains very high. Core inflation, which strips out volatile fresh food and energy prices, was 7.5% year on year, slightly below the 7.6% recorded in February, the data showed. So core inflation barely went down. And listen to this, food prices have hit Spaniards' wallets hard, climbing more than 16% in February. From a year earlier. The government cut value-added tax on essential foods such as bread, cheese, milk, fruit, and vegetables, and cereal to 0% from 4% to ease the inflation pain. So there is a reason why inflation went down in Spain, but core inflation remains absolutely alarming. When it comes to Germany, the headline reading is down to 7.8%. Thank you to energy prices going down. But this was a disappointment. The reason is core inflation once again. According to non-harmonized standards, German consumer prices rose 7.4% on the year in March and 0.8% from February, so inflation going higher month over month. That compared with annual inflation rates of 8.7% in both February and January. And according to the economy minister, he says, I won't speak of a reverse trend from February to March, but the decline is strong. Oh, really? Because food prices continued to rise rapidly, up 22.3% year on year. The decline in the inflation rate was entirely driven by a slowdown in energy prices, which rose only 3.5% compared with March 2022, when the shock of Russia's invasion of Ukraine caused a huge spike in cost for oil and gas. The German Statistics Office does not publish a figure for core inflation, but according to Commerzbank estimates, the inflation rate excluding food and energy prices stood at 5.9% in March, well above the ECB's 2% inflation target. This is raising worries that the Eurozone's central bank, that sky-high energy costs have seeped into the broader economy via second-round effects, making it difficult to root out because it is fueling cost increases across the board. Bingo! On top of that, Europe's labor market is so tight that workers have gained bargaining power, and wage growth is now between 5 and 6%, its highest in decades. And we are aware about the massive strike in Germany, of course, and here it is. Wage negotiations for Germany's public sector failed this week, although employers offered almost 6% pay growth per year for 23 and 24. That's not enough. The significant rise in labor costs should keep core inflation rate well above the 2% mark, and thus prompt the ECB to raise interest rates at least twice more, according to Commerzbank. And we will see the same problem here, folks. Core inflation will remain sticky, and a bunch of small banks blowing up, that's not going to take care of it. The Fed will have to intervene and raise rates furthermore, and then the dollar is going to rebound and the rally goes kaputs. In the meantime, the bears, of course, are capitulating all over the place. We know that the sentiment is euphoric among the bulls because they got SVB collapsing. That solves all problems. The Fed will back off, and even if they say they're going to raise rates, they're just bluffing, and inflation is not a problem anyways. Just shut up and buy. But when it comes to the bears, what is the sentiment right now? The market is irrational. They're going to continue to buy the dips. We're going to go all-time highs from this point on. The crash will never happen. You gotta trade the market right in front of you, Maverick, and I'm just gonna capitulate and buy everything right now. And next thing you know, boom, they pull the rug. And among the bears capitulating today is none other than the big short Michael Burry, who says going back to the 1920s, there has been no BTFD generation like you. Congratulations. And I was wrong to say sell. The problem when he said that, actually the market went down. So he was not specific. Sell now and then buy later. Sell now forever. Sell your kidneys. Sell tomatoes. He did not specify anything at all. And the problem is, if you want to use the Michael Burry inverse index, when he said sell, there's another famous inverse index who said buy, and that is Jim Cramer. So when Cramer says buy, Burry says sell, what do you do then? It's a glitch. But folks, I am happy to see the sentiment changing. It was, let's say, excessively bearish in the last few weeks, specifically after the implosion of SVB. And now the sentiment is becoming excessively bullish. This is the new bull market. The Nasdaq is in a new bull market. This is what I heard today. It's up over 20% since the bottom. That's a bull market in the books. Inflation doesn't matter. The Fed doesn't matter. Valuations don't matter. Corporate earnings don't matter either. Keep going. I want to hear all-time highs. I want to hear somebody comes on TV and says, this rally will lead us all the way back to all-time highs. And I want to hear more and more bears capitulating, and then I'll trade accordingly. And speaking of, let's move on to cover the stock market information for you. And we begin with the closing of the indices today, and here we go. The Dow Industrial Average up in the green by 141.43 points, or a gain of 0.43%. The Nasdaq positive by 87.24 points, or a gain of 0.73%. Likewise, the S&P in the green by 23.02 points, or a gain of 0.57%. We'll look at the sectors. Risk on once again, although financials are kind of sending a warning sign here, but for now, who cares? More banks blowing up, that's good. And at number 1, capturing the gold medals, cyclicals. Number 2 for the silver, technology. Number 3 for the bronze, materials. When it comes to the advance to decline ratios, what do we see here? The NYSE 64% advancing versus 34% declining. The Nasdaq 47% advancing versus 49% declining. So despite the upside day, the breadth remains absolutely awful. And these are the kind of warning signs telling us that this rally is not for real. When it comes to commodities, what do we see here? The dollar was down by about half a percentage point or so, and therefore this was good for oil, good for metals. We see crude moving higher, the WTI gaining almost 2% for the day, while Brent closing higher by about 1%. The loser once again in energy commodities was natural gas, down by about 3.25%. It is retesting the lows once again. So long as it doesn't break below the lows, so far, so good. If it breaks below the lows, we got a problem. But if you look at the chart of natural gas, we are already at multi-years lows. How bad will it get? And as we get closer to the summer season, the possibility of the mother of all short squeezes becomes more and more possible. When it comes to softs, green across the board, and the rally led by sugar futures up about 3.5% for the day. The laggard, lumber, once again, beat on the flat line. When it comes to metals, we have a rally across the board, but once again, silver is outperforming gold, and better yet, platinum and palladium outperforming copper. Why is copper underperforming when the dollar is down? It's just something to keep an eye on. If we continue to see copper underperforming, that is perhaps a more reliable indicator for the recession theme versus gold. When it comes to meats futures, gains across the board, worth about 0.75% apiece, and then when it comes to grains, mostly in the red, and the declines led by wheat futures down about 2% for the day. Moving on to the big casino, the options market, what do we see here? The volume all in all down, which tells me that these pumps by the institutionals to score bonuses by quarter end, these pumps are not attracting a lot of retail mom and pops. Some are being sucked in, but a lot of people are saying, yeah, I'm not buying this one. And therefore, we see some buying of call options. A lot of folks are taking a shot at the rally by buying call options, but we're not seeing a huge volume, a huge follow-up. We see a gap and then consolidation all the way till the end of the day. And it happens is under low volume, which means once again retail mom and pops are not participating in large numbers. With that being said, the hottest table by far, Tesla, the souffle, with around 1.7 million contracts traded today. About 59% of those were calls. And at number 2, Apple, the big kahuna, with around 800,000 contracts traded today. About 52% of those were calls. And at number 3, Amazon, with around 770,000 contracts traded today. About 69% of those were calls. So as you can see, lots of call options buying versus puts. Yet another indicator that we're getting closer to a major reversal here. On to the unusual activities that took place in the options market today. We begin with the ticker RL, Ralph Lauren. Now, somebody sees the name moving down and they bought the 100 puts for the expiration date, June 16th, with the expectations that RL will go down and lose more than 12.5% of its value by then. They paid around $3 a piece to enter this trade, all in all spending around $3 million. And then we have what it appears to be a strangled trade. You can read it in a million ways or so, but if we look at the chart of UAL, United Airlines, what do we see here? We see a strike price with a 36, that is the put trade, and then we see the 46 with a call trade. The stock is now stuck between this range. It appears weak, but it also appears that it is changing momentum. Perhaps it will move all the way closer to 46. So the trader says it could go either way, and I'm going to play it by buying both calls and puts, but I'm going to adjust the strikes accordingly. I think if there is a move higher, it's going to take a while, and by June, it'll take us all the way by 5% or more from this point on. But if there is a move to the downside, it would be because perhaps the entire market is crashing. It will be a major move. It could be more than 17.5% to the downside by June 16th. And therefore, the trader bought the 36 puts and they bought the 46 calls, all for the expiration date, June 16th. They paid around $2.65 a piece for buying the 46 calls, and they also paid about $1 a piece for buying the 36 puts. All in all, you put it together, the entry cost is about $3.65 a piece, which brings the total all the way to about $3 million. Last but not least, we have the ticker PM for Philip Morris. Here we have somebody who sees the name moving down and they bought the 87.5 puts for the expiration date, June 16th. With expectations, the PM will go down and lose more than 9.5% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $600,000. On to the heat map. What do we see here? Green across the board, not led by the major caps, the big cap technology names. It was actually spread across the board. Metals participated, cyclicals did too. The defensives, big pharma, the Chinese names all participated in the rally today, along with some industrial names such as waste management. That was a decent pop in the name. And of course, chips participating in the rally. But of course, the notable absence comes from TSM, Taiwan, and Google in the big caps. Alphabet is not participating today. And of course, when it comes to the decliners, we have biotech, lots of speculation in biotech in the last few days, so we have some profit taking here. But most alarmingly, we also have financials down big, be it regional banks or even big banks. And this could be a catalyst for another pullback. If we see the credit swaps blasting higher again and the shorts piling in, and more fear that another bank is going to blow up. I mean, look at Schwab today. That's the most alarming one. Why is Schwab down big today? I know there's an analyst from Goldman Sachs who downgraded the name, but the move in Schwab is absolutely alarming. Something big is happening in Charles Schwab, and we deserve to know. If that thing blows up, I don't think the bulls can brush that as, oh, that's Silicon Valley Bank. It means the Fed will do so and so. Because now it becomes, wait a minute, the dominoes are falling and nothing will be spared. Now, when we talk about corporate news, what about the tsunami of layoffs? And today we got more data from Roku, laying off 6% of its workforce. And of course, this comes on the heels of EA, Electronic Arts, announcing laying off 800 jobs yesterday. We continue to get more and more bad news regarding the economy, but again, the market looks at this as good news. It means the Fed will have to back off. There is this delusion and fixation about, oh, the Fed will do this and that. Major mistake, folks. But for now, there's nothing we can do. So we have to move on to the heat map for the ETFs. What do we see here? Mostly in the green for the most part. We have some laggards led by financials. We talked about that. But also energy lagging today. Biotech. We have large caps taking back the leadership of the market from small caps. International markets are doing pretty good. The recession trade of UMAV, gold miners, silver, that's doing pretty good. So we have a market that is split all over the place. For example, if you happen to be in the recession camp and you say you gotta go long gold and silver, today you got rewarded. If you're in the camp who says, oh, we have systemic risk right now and the Fed will have to cut rates sooner or later, and you're buying technology, you got rewarded today. And if you don't like the valuations here in the US market and you went instead with the international markets, you got rewarded today. And the market is rewarding pretty much everybody. And this is a sign that this is not sustainable. The market cannot reward everybody. One theme, one team will win. Is it going to be the recession crowd? Is it going to be the expansion crowd? Or the Fed is going to back off? Everything is pretty good. Is it going to be the stagflation crowd? Is it going to be the recession crowd? At the end of the day, tomorrow, we have a decisive day. We got PCE inflation, and next week we have more inflation data, and it all depends on the dollar. At the end of the day, this market moves based on the dollar. The algos are now wired to track the dollar. Dips in the dollar means rips in the equities market led by the Qs. Rips in the dollar means dips in the equities market led by the Qs. And since we're talking about all of that, let's do some charts and then wrap it up. And we begin with the SPY, the S&P 500. And we're using an hourly chart this time around. We have another gap higher. Here we go. Very low volume today. You can't do anything about it. When you have a gap higher, what do? You buy calls, you're going to lose money right away because of this consolidation. You buy puts. If the chart doesn't go down, breaking the support line, you can't really do that. So there is nothing you can do. For now, we have support at 401.20. We have the resistance all the way up at 405. But of course, we know that you can't cheat your way above these important lines. All of this gapping above 398, I promise you, we're gonna have to go down and sort all of that out. And therefore, 398 will be a magnet that will pull the chart down. You gotta do a proper testing of 398 before you can rally higher. What about the daily chart for the continuous contract for the S&P? What do we see here? We're now above the resistance, now support of 4,037. You can round that down to 4,000. And now we have 4,100. Can the SPY close the week above 4,100? That will be extremely bullish. But even if it closes above 4,000, that will be good enough for the bulls. The bears need to see a weekly closing below 4,000 and the volume spiking higher tomorrow to say, okay, you played your game and next week we're going to feast on you. But it requires high volume. It requires a closing below 4,000 by the end of the week. For now, what we know looking at the momentum indicators, they remain positive. The RSI is firming up. The MACD indicator is showing positive impressions on Instagram. So until we see a reversal, we're not going to say that the SPY is turning around. But perhaps an early warning sign is when we look at the volume, this is the weakest volume for the year so far. So we've been rallying based on weak volume because we know who's been buying. The money managers, they're pumping in the pre-market to score those bonuses. What happens when the volume comes back in? The volume will be of selling, not buying. And while we have an inverse head and shoulder formation in the daily chart of the continuous contract, when we look at the cash index, a weekly chart, we still have an actual head and shoulder formation. What you want to watch for is tomorrow's closing. If the chart closes the week below 4,000, then the probability of a head and shoulder formation becomes highly likely. What about the Qs? An hourly chart, what do we have here? We have yet another gap higher, this time around cheating 313. Major mistake. Now the Qs is under the curse of 313 and it will take it down. I promise you. We have to go down and retest all of these support lines properly. Once we're done with the monkey business of the end of the quarter, they have to go down and retest 309, but most importantly 313. You can't pass this number by gapping higher. Look at what happened last summer. Same mistake, and it was a rug pull. Likewise, we don't use the daily chart for the Qs in this program a lot, but I'm doing so tonight to show you the Bollinger Bands indicator. It doesn't give you a buy or sell indicators, but it tells us that the move is getting overextended here. We're getting to the limit. Maybe we can push it all the way to 316, maybe 320, but that would be a stone cold short at 320 if it happens to begin with. When we look at the daily chart for the continuous contract for the Nasdaq, what do we see here? Above the resistance, now support, let's say 13,000, and now the chart is eyeing 13,300. A long shot, but again, a closing above 12,766 by the end of the week is good enough to keep the bulls in charge. If we have a nasty reversal tomorrow, we close below 12,766, then we have a major reversal. But for now, the volume is down. You can look at this as a bullish indicator in the short run. The sellers are nowhere to be found, and therefore the volume is down. But you can look at it from the bearish lens too, that sooner or later, the volume will show up, and in this case, the volume will be to the downside, the opposite move. When you have a certain move up or down based on low volume, when the volume shows up, it comes in the opposite direction and it produces a sizable move. and hence the risk of a rug pull. The momentum indicators for now remain positive, be it the RSI or the MACD indicators, pointing out for more gains to come, the possibility of more gains to come. When we look at the hourly chart for the IWM, small caps, what do we see here? We got a gap and crap in the IWM, closing negative yet above 174.22, forming a bear flag pattern. Can we take it for granted that the IWM will go down? Not really, because it did not close below 174.22. But now the indicators say that the IWM is running out of gas already. Absent of a miracle tomorrow, sooner or later the IWM will go down. But this is not a death sentence yet, and the reason is the IWM is still keeping 174.22 as support. The Dixie 4 hours chart, what do we see here? It failed to pop higher from what we showed you yesterday on the 4 hours chart. It appeared almost likely, but the dollar reversed down. Now it is keeping the double bottom. All what the dollar needs is to crack above the negative trend, and the confirmation would be securing 103 as support once again. If that happens, it will mark the end of the rally in the Nasdaq. And if it does happen, it will be bad for gold. Here's a daily chart. What do we see here? We got a pop today, not forming a higher high yet, but we have a lot of call options buying for the 2000. Now my hunch is it's not going to be this easy. Otherwise, everybody will win, because everybody bought the 2000 calls. I think the market will play games. I think it will push gold down to make sure that the majority of those contracts expire worthless, and then it pops gold higher. In the meantime, look at silver. SLV made it above 21.57. So far, so good. Mission accomplished. Now, can we keep this support by the end of the week tomorrow or not? If we do, very good sign that yes, we might see consolidation and work out all of these overbought conditions in the SLV, but sooner or later, we're going higher, baby. But if we do close below 21.57 by the end of the week, nasty reversal, not a good sign, but it will only happen if the dollar pops significantly higher. What about Brent oil, a daily chart? What do we have here? Another critical closing here. It is now trading above 77, but can it close by the end of the week above this number or not? A closing below will revive the bearish / the recessionary thesis that oil is a short right now. A closing above 77 by the end of the week will reenact the inflation theme, and oil bulls will be rejoiced that, hey, even if we have some trouble right now, we're not at the recession part yet. Maybe we'll get there at some point, but for now, be it an inflation theme or a stagflation theme, oil should move higher. And therefore, the weekly closing couldn't be more important. We'll look at the 2-year yield. What do we see here? A daily chart. The momentum says it is waiting for a spark to pop significantly higher, maybe all the way to closing the gap at 4.59. Long shot, but it is possible. If inflation data comes out hot and the conversation shifts to, oh, the Fed will have to do more now. Likewise, the 10-year above 3.5, can it close above this number by the end of the week or not? The mystery becomes, how will the 10-year react, let's say if we have a high inflation print? We know the 2-year is going to blast higher, but will the 10-year also go higher, or will the 10-year go down? If it blasts higher, then it's going higher based on Fed rate hike expectations, meaning a revival of the inflation theme. If it goes down instead, it is sending a message saying that the Fed will have to raise rates, and this will exacerbate the possibility of a recession. And we might see the phenomenon of the dollar moving higher, but the 10-year moving down, and oh, by the way, gold catching a bid despite the pop in the dollar. That could happen. This is a possible scenario. We have a lot of divergences right now because things are wired one way or the other. Certain charts are still wired on the recession theme, others still on the inflation themes. We have many charts wired on the expansion theme. So when we have a piece of data that comes out and says the resolution is fill in the blank theme, certain charts will have to readjust. And then we see correlations that we've been depending on for years and years not applicable anymore. The TLT, a daily chart, what's going on here? Above 103.5, we have a critical day tomorrow. If the 10-year pops instead of moving down, TLT will go down big. And therefore, I did buy some TLT puts as a hedge in case we have a pop in yields just for the expiration date of tomorrow. The VIX 4 hours chart, what do we see here? Look at the volatility in the volatility index. Unbelievable. We got a pop in the morning that got us all the way to 20. And then by the end of the day, we got a flush down that got us all the way to the lows of the day. Any message here? We know that we have support at 18. We know that we have resistance at 20. What are the momentum indicators saying? We could go back to 18. That's possible. But the momentum indicators right now are so weak and they're turning around. The the most likely scenario is that the VIX gave it a shot at 20 today, couldn't make it, but in tomorrow's session, we'll give it another shot and finally pop above 20 once and for all. Now, what is the importance of knowing such information? The answer is, we covered a chart, I believe a couple of days ago, the correlation between the VIX and the NASDAQ. And every time the VIX goes down to 20, 18, and then it rebounds higher quickly, it's a sign that the rally in the NASDAQ is going to reverse. But if we see the VIX going down below 20 and sitting there for a little while, it's actually a good sign for the cues that we're going to see a continuation of the rally. So keep an eye on the VIX and how it's going to close by the end of the week. And here it is, the big kahuna, Apple, an hourly chart. What do we see here? If you want to pump the market because you want to get bonuses, the easiest way in doing so is by pumping Apple. You pump Apple, the SPY goes higher, the Qs goes higher, every major index goes higher. But again, we're getting overextended here. Not by a lot, we could make it all the way to 163.33 and then the rug is pulled. We identified another target on the daily chart in case we have, let's say, the most bullish outcome. But my hunch is we finish the end of the quarter rebalancing, the chart gets way overextended, and then the talking heads who've been saying that Apple is safety, Apple is the way to go. After they're done pumping, they're going to come out and say, oh, but the big caps are kind of overvalued right now. You got to be careful. Maybe you want to take some off the table. Yada, yada, yada. Because at that time, they will be shorting. Tesla, an hourly chart, what do we have here? It remains relatively weak. Yes, it was a positive day. Yes, it popped higher. Yes, it got 194.55 as support. But we're not seeing this massive pop that we're seeing in other names. Now, the closing above 194.55 is bullish, not bearish. So the bulls, for all intents and purposes, could give it another shot tomorrow at 200. Are they going to fail or not fail? I would say closing above 194.55 is good enough for the bulls by the end of the week. If the bears want to take charge of this chart, they need to make sure that Tesla is going to close the week below 194.55. And here it is, last but not least, Bitcoin tulips. What do we see here on the daily chart? We got a positive day initially, but we got a reversal by the end of the day, closing at the lows of the session. We see that the RSI is in negative divergence. The MACD indicator is about to cross, producing negative impressions on the histogram. Is Bitcoin about to reverse and lose 26,555 as support? Entirely possible if the Dixie pops higher. And if it does, and Bitcoin goes down, isn't Bitcoin a leading indicator for the risk-on sentiment in the stock market too? Something to watch for. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have a lot. We have personal spending and personal income, but most importantly, we have the PCE inflation index, which comes with core PCE, which will probably hold more weight than the headline reading. And then we have the Chicago Business Barometer, along with the University of Michigan Consumer Sentiment Index. We have a bunch of Fed zombies speaking tomorrow, led by New York Fed President Williams. And then we have Governor Cook and Governor Waller also speaking. Lots to look forward to, but this is all I got for you for now, folks. I do have a feeling that I'm going to have to talk to you again on Friday, but if nothing else happens, and this is all I got for you for now, thank you for listening, thank you for watching, and I will talk to you again over the weekend. Take care.
New day. No more craziness. Back to the quiet.
737 Ignore me, set it for 1824. 737